So coming to today's session, like I said, it's about funding your startup venture. So it will talk about different, it will cover the entire journey of funding your startup, and more importantly, how do you consider all the financial aspects? How do you manage all, your day-to-day finances for your startup to be viable and for it to keep building? And for this, today with us, we have a finance wizard, Mr. Irfan Karim, sir. He's an accomplished finance leader with over 25 years of work experience in corporate finance and accounts across sectors, specializing in manufacturing and trading and ITES sector in India and Southeast Asia. Currently, he's founder and director at Pentamerous Solutions, and sir has a very strong background of finance, and I hope that he'll be sharing tricks and different aspects of his trade from his experience and help us all to learn a lot of things. If all of you have any doubts, we'll have a separate Q&A question and answer round with the panel later, so that you can learn more and clear all of your doubts. Saurabh Sinha sir will be the moderator for today. Sir is the founder of Rein Labs. He's a serial social entrepreneur and has been, raising multi-million-dollar rounds with global VCs. He's a startup coach and seasoned mentor, having mentored more than 200 plus college projects and 100 plus startups. So sir will be routing the right questions to Irfan sir and taking up few questions that are in his expertise and domain, so that we all have a mix of both the speakers and we get to learn the most from both. Before I hand it over to Irfan sir, just a few admin rules and regulations. Currently, everybody is centrally on mute, so that it gives better clarity for the speaker and for you to understand. So at the end, you can put your questions in the chat box when it will be open for all. For any queries, we'll be putting down an email ID and a number where you can connect. So those details will be put up on the chat box. Also, anything related to testing and certification, or the details will be given in the chat box during the session. So thank you so much. Over to you, Irfan sir.
Thank you, Purti, for a generous introduction. And I must thank Rein Labs and Saurabh for making me a part of this journey. And I look forward to this session and many more sessions, hopefully, to make a positive impact to the innovation, boost that is happening in our country. So let me, kind of straight away jump in. Now, this is a finance section, a finance session. So, you can expect, a lot of numbers and typically a lot of charts and a lot of Excel files. So yes, there is some of that coming your way. But what we will do today is that, we will look at an actual case study. So there's going to be a story which is going to be presented to you. We'll look at an actual case study, which I was involved in. And, it was an actual startup case study, which started its journey in January of last year, which is, just, while the country emerged out of the first wave of lockdowns and COVID wave. So it, kind of started its journey in January. The journey is still on. So this kind of covers the first year of the journey of that startup. Some of the figures, that you'll see, are directionally correct. They may not be accurate because, for the sake of simplicity, I have rounded off numbers, because it's important to get the message across rather than the accuracy of the numbers. So that obviously is there. So maybe let me just straight away jump into that story, and I'll share my screen. Okay, so I hope the screen is visible to everyone.
Yes, sir.
Okay, let me just adjust my screen settings so that even I can see everything rightly. Okay, so I've named this story "Buck Up Sid." So Sid is the hero or the protagonist of our story, and this is the actual, like I said, a case study of a restaurant startup. And before we, kind of start, I just want to, let me just again adjust some of my screen settings. Yeah, So, before I start, let's just meet, this protagonist. So what's his background? So he, had done his civil engineering, and he had entered the job market. Okay, he worked for a couple of years with some real estate developers in Mumbai and Pune, but he was missing the job satisfaction, and he always had an urge to be an entrepreneur. There were certain other factors which, obviously are not relevant to this story, which I have, kind of skipped. What he did was that while he was, kind of going through that journey, and while he was working with a developer in Pune, he already had this urge, and, he said, okay, let me start a restaurant. He had identified some people who could help him, set up the restaurant. So while he did the preparatory work while, he was still working for that, developer in Pune. He identified a location, and, he prepared a business plan. He reached out to a few people from his circle, largely family and friends, somewhere around November, December of 2020. That's when, if you just keep this in mind, that's when, the country was emerging out of the impact of the first lockdown. And, this is, broadly the business plan. Now, I know this is a lot of numbers, so you don't need to focus on the details. I'll just point out to you the salient features. So just stay with me. Okay. So again, this was a far more detailed, business plan. What I have displayed here is purely a cash flow statement from his business plan. Okay, split over 4 quarters. And, so like I said, he had identified a restaurant. Okay. And this restaurant actually had, already was a place which had already closed down, during COVID-1. So it was already a restaurant earlier. So most of the infrastructure was in place, and it didn't require a lot of initial upfront investment because the infrastructure of a restaurant was already there. Of course, some more work had to be done there, but that was the reason why the initial investment was low. So this business plan, if you see, from in Q1, broadly the target was to kind of start from a daily revenue of about 3,000 rupees a day and scale it up to 10,000 rupees a day by the end of year 1. So that was broadly what was the goal. Initial investment was supposed to be about 5 lakhs, which would have taken care of the initial needs and the initial funding. And it was expected, as per this business plan, that the business would stabilize by Q3, Q4, and be self-sufficient by Q3, and by Q4 it should turn kind of cash positive. So that was what was broadly the feature of this business plan. So he kind of shared this business plan with his circle to see if he could raise that 5 lakhs initial target. Now while he shared this, there was one gentleman who got interested. They met, they discussed, they had various rounds of discussions, they negotiated, agreed on terms, and he got the funding of or a commitment of 5 lakhs funding. What he did was, so I'll break this story in 4 parts, the 4 quarters, and kind of see what happened in this journey across 4 quarters. So what happened in Q1, the initial part was obviously to the very first month was to set up the restaurant, hire the staff. The staff was, as I said, he'd already done some informal kind of identification. So the staff was identified, hired very quickly by the end of December and first week of January. The restaurant, as I said, it was already, the infrastructure was already there, and whatever little bit work had to be done, that was done. And the restaurant started operations actually by 10th or 11th of January of 2021. Okay. So initially it had a good start. It started getting good response. By February, the restaurant was already generating, some revenues of about 4,000 rupees per day. And, it was, kind of on track for meeting its Q1 targets. So, the initial, kind of setup and, start was on a very positive note. Now, let's again, come back and look at, okay, how did actually this business do, by the end of Q1? Okay, so here you will see, again, I don't want you to get overawed by a lot of numbers on this Excel file. I'll kind of take you through the highlights. But if you'll see here, what I've done is I've compared the actuals of what the business generated versus the plan or the budget. Okay, and kind of we'll talk through that. So as you can see, the revenue, is more or less on track. Marginally missed the revenue target by about 10,000 rupees or 3%. So that was fine. However, the kitchen supplies cost, that came in higher by about 20,000 or 13%. And Sid explained to the investor that more stable, this was Q1, so just he had started off. So he said he assured the investor that more stability and efficiency shall be achieved in the coming months in the operation, and he'll get over this adverse variance of 10-15% on the kitchen supply cost. So that's what happened, and more or less, as you can glance through this Excel file, more or less the other expenses were more or less in line with the target. Of course, because of these two variances, the cash flow was slightly, or the cash generation was slightly lower. And another thing, which is not highlighted, but I just bring to your attention, the investor had put in, the 5 lakh rupees that was committed by him in Q1, of which 2.5 lakh rupees went in the restaurant infrastructure and equipment. And the balance obviously was used for, the initial funding gap between the revenue and the costs. So this is how, things, kind of panned out in Q1, more or less in line with, what was planned. Let's look at, what happened, in Q2. And, you will all recall that, April of, last year was the unfortunate period where, where the country was struck by a very severe second wave of COVID, and that caused a lot of disruption to everyone. And, the hospitality or the restaurant business was no exception. So there were a lot of restrictions, and this was in Pune. So there were a lot of restrictions, imposed by the local authorities on, what could and what could not be done, to control the spread of COVID. And so that was one thing that happened, at the very beginning of Q2. And, coincidentally around that same period, the head chef, he lost his brother. So the head chef had to, kind of go back to his native place to support his family. And, it took a few days for Sid to, kind of find a replacement. So these were the two challenges, which kind of hit the business in Q2. And so Sid took the challenges, head on. What he did was that, he, converted this, difficult situation into an opportunity. What he did was that, he, by that time he had already, in the locality that he was operating, he got a, he had a base of clientele, plus he had set up his presence on social media for the restaurant, etc. So there was a good, marketing buzz that was already happening in Q1. So he leveraged that. What he did was that, and he wanted to, given the difficult situation, that happened in Q2, where, people lose livelihoods. We've all seen that. People lost livelihoods. There were difficult people at the bottom of the pyramid, they kind of go through really difficult times, when lockdowns are imposed. So he started this initiative, he had a restaurant, he had the infrastructure. So he started the initiative where he encouraged people to come forward and sponsor or, help in meals, which he, used to go and distribute it amongst the people who couldn't afford even decent meals at that point in time. So that's the initiative he quickly kind of diversified to, versus kind of sitting idle and kind of doing nothing while restrictions were imposed. Now, so this helped generate some amount of revenues. Okay, obviously the dine-in business suffered a lot because dine-in, if you remember, was not allowed during those times in that part of the country, at the peak of the second wave, and it further generated goodwill and good name for the restaurant in the locality, because people saw that he's giving back to the society, and trying to help people in whatever little way that he could, who are kind of stuck in difficult times. So that was a good outcome of this initiative. And the other thing that was allowed, obviously, and these restrictions kind of accelerated that the move towards that was he started focusing and developing more on the takeaway business and the home deliveries, because that is something that was allowed in those restrictions. Restrictions were placed on dine-ins. Dine-ins had been stopped, but there was very little restrictions on takeaway and home delivery. So he started kind of focusing more on that and developing that part of the business. Okay, and obviously since the head chef had moved out, okay, he had to find a replacement, which he very quickly, I think within a couple of weeks, did, and kind of got the restaurant back on track. So this is how he kind of dealt in his own manner with the challenges that I just showed on the previous slide. So what happened is that obviously Q2 ended, and so did the COVID wave. I think by end May or early June, at least it had tapered down significantly. And we as I said, this was indeed a very challenging quarter. Everything did not go according to plan, and Sid did what he could in those difficult circumstances to respond to those challenges. But the Q2 ended, and it was time to review the performance of the business with the investor. So what happened? Let's have a look at what happened in Q2 in terms of numbers, as I've been showing you. So again, here you see a bigger Excel file, more columns, because we are not going to only look at what happened in the quarter, but we'll also just keep an eye on how things pan out from a year-to-date point of view. So cumulative 6 months. Okay, so this first part of this Excel file that you see on the screen, that's talking about the quarter, and this right-hand side is talking about how the year-to-date or 6 months numbers are there. Again, too many numbers here. Don't get overawed. Just stay with me, and we'll talk about the main highlights. Okay, so first of all, for Q2, there was a significant miss in terms of the revenue. So the revenue came in nearly 30% lower than the Q2 plan, which was about 480,000 rupees. The revenue came in at about 340,000 rupees. So this was obviously because of the challenging situation. The kitchen supplies, that continued to come in higher. So although Sid had said that we'll get over it, but there were various reasons for this. Some of which were identified, some not in Q2, because there was a lot of chaos actually happening in the business. But in finality, it had come in higher. So that impacted profitability and cash flows. And because of that, because the revenue came in lower, the costs were higher, there wasn't much, kind of change, difference that was there in other expenses. Okay, those were more in line. So because revenues were lower, costs were higher. Obviously, there was a funding gap. So Sid had to arrange for some emergency funds of about 2.25 lakhs in Q2. And these were interest-bearing emergency funds. So you can see some interest expenses also started creeping into the P&L, which was not there in the plan. Okay, so that's how, you know, had to raise this extra. He had to raise this extra money to make sure that, you know, the Q2, despite the challenges, you know, kind of, you know, he had to emerge out of that challenging situation. Okay, there were some other things that, you know, kind of a deeper dive. You know, if you look at the revenue, you know, it showed. So overall, you know, if you see in Q2, because of the restrictions on dine-in, you know, almost, you know, 10% of just 10% of the revenue actually in Q2 was dine-in, and almost 90% of the revenue was coming from takeaway business. Okay, and this is for the quarter, but if you look at the trend of the last month, which was, you know, about 3 weeks of time where, you know, the restrictions were less severe. Even there, if you see, although the restrictions were less severe, people had not yet ventured out completely, and you know, the takeaway business was still 80% for the month of June. So this is something that you know, was an additional takeaway from Q2. Okay, hang on. Yeah, and obviously, and we touched upon this, you know, but here's a little more factual data on, you know, the kitchen supplies cost. Now, the original plan had about 40% or thereabouts on, you know, the kitchen supply cost, but the actuals had come in at 55%. Okay, so this was you know, a significant higher cost that he had incurred. Now, obviously, you know, after looking at these numbers, you know, the investor, you know, kind of made two recommendations, and, you know, typically, and this was a, you know, like more of a kind of a professional investor. So, you know, they also keep, when they invest in businesses, they keep a pulse on what's happening, how things are going to pan out, and they keep a pulse on the market. Now, he made two recommendations to Sid. One was that he said that, you know, I mean, looking at the trend, you know, this seems to, he suggested that, you know, I mean, at this point in time, there isn't much need for a large place because there isn't much dine-in happening. So let's shift this restaurant in the same locality to a smaller place, you know, to save on rent costs, which was a significant portion of the cost. And he urged Sid to, you know, kind of go back and investigate, you know, what's happening on the kitchen supplies actually, and reduce wastage, you know, and you know, go back and, you know, come back with a more detailed analysis in terms of what actually are the reasons. Because, you know, while you know, the numbers showed that, you know, it had come in higher from 40 to 55%, Sid couldn't at that point in time explain the actual reasons why it was higher. Was it higher because of inefficiency? Was it higher because he was procuring it at higher cost? Was it higher because, you know, the original you know, sales price was, you know, per meal was lower than what was anticipated? So it could have been a factor of various reasons, but Sid at that point in time was not prepared, you know, with answers to all these questions. So it was agreed that, you know, he'll go back and, you know, kind of come back with a more clear, you know, response to what is causing this, you know, increase in cost. So that's what was agreed, you know, at the end of Q2. Okay, let's, you know, kind of move to Q3 and see how things, you know, kind of evolved in Q3. So again, you know, Q3, there were certain things which happened. The first thing, obviously, was, you know, there was an investor recommendation to move to a smaller place. Now, Sid, in his heart of hearts, did not agree with that recommendation. So he did not, you know, kind of go ahead and made efforts to, you know, kind of implement that recommendation. Instead, he tried some marketing initiatives to, you know, kind of increase the footfall in the restaurant. And, you know, again, not relevant to the topic, but there were some interesting things that he did, but it's not obviously relevant to the topic, so I'll skip that in the interest of time. But yes, there was an effort made. Okay, he took a decision not to go with the investor recommendation, and, you know, said that I'm going to try and increase the dine-in revenue. But obviously, when you do that, there is pressure on costs. So if you, kind of money is always a limited resource. So if you make a choice of going down a certain way, you will have to compromise on some other thing. What he did was that, there was cost pressure. He'd already exceeded and taken more funding than what was originally in his business plan. So he had to, kind of manage costs. There were two cost pressures on him. One was the rental cost of the restaurant, which was a large place, which was not being fully utilized. And there was, the other aspect of the kitchen supply is not, he was not having a full handle on that cost. So what he instead did was that he tried to rationalize some staffing, and he reduced, one staff to kind of manage some things, on his P&L and his cash flow. So let's see, he did this. Okay, let's see what was the impact of this on his P&L. Okay, so again, if you look at this Excel file, again, don't get overawed by a lot of numbers which are there on this Excel file. I'll take you very systematically through, what the salient features are, but just for the sake of understanding, the left-hand part is the Q3 actual versus plan, and the right-hand side is the year-to-date numbers of, how things have panned out by the end of 9 months, which was by the end of September of 2021. So let's see what happened. So first is revenue. Again, although most of the restrictions by Q3 had been lifted, the revenue did not come in, as per the original plan. So there was a 25-26% miss in revenue. So the plan was about 675,000. The revenue came around, 500,000. Okay, so there was a miss in revenue. Kitchen supplies, did not come in control. On a lower revenue. So again, I didn't want to complicate too much on this Excel file, but if you just see on a lower revenue of 26%, the kitchen supplies came in higher by about 14%. So it's not just, 14%, because, ideally, this is a very straight away a direct cost. So if your revenue is lower by 26%, your kitchen supplies should be lower by 26%, but that's not happening here. So revenue is lower by 26%, but kitchen supplies are coming in higher by 14%. So it's a double whammy. So this cost item was really out of control. Okay, so we'll see, in the next slide, what's happening. As I said, in the earlier slide, that he had rationalized on one staff, so that partially kind of helped him a little bit in terms of managing costs, but at the end of the day, this was still not enough, and he had to raise another $150,000 rupees to just make this cash neutral at the end of the quarter. So there was a gap, given the lower revenues, given the higher kitchen supplies, partly compensated by the reduction in cost. There was still a gap in his cash flow, and he had to raise another $150,000 in Q3 to kind of just stay above board. So that was what was happening. So this is what happened in Q3. Now again, it was time for some deeper dive, and you can see here that I don't have it put up in a chart format, but again, the revenue was dominated by takeaway instead of dine-in, because I think by that time people had still not become comfortable with venturing out a lot, and people had got used to. You can imagine, we all have got used to. We don't even today, after the COVID wave have subsided, at least in major cities. People have shifted big time to online ordering versus going to the grocery store or the local store to buy your provision. So there has been a shift in lifestyles of people because of these things. So revenues continued to, obviously, even in Q3 came largely from takeaway instead of dine-in. Now the investor was not too happy. because Sid did not act on his recommendation to move to a smaller place. So, and this was validated. The investors, hypothesis was validated, saying that now the business is shifting more towards takeaway. So there's no need for a large place. Sid did not agree with that decision, and he did what he wanted to do, and that obviously kind of led to, we saw on the previous slide how the actuals came in adversely to the plan. So the investor was not very happy, and obviously Sid had to as I said, raise another 150,000 rupees on interest to kind of manage. On the kitchen supplies, again, Sid, the cost was not in control. We've spoken about it. Again, the actual was coming in at around, in the mid 50s, whereas, when the business or the plan was made, it was estimated to be around 40%. So that, was an aspect of business which was still not in control. Now, what also was upsetting to the investor at this stage was that Sid, again, not only the cost was not in control, but Sid could not, kind of come back and actually pinpoint the reason why this is happening. So, like I said earlier, it could be a combination of various factors, and it is very important when, whether you're in a startup or whether you are, kind of running your business to be able to, capture data and, analyze that data, because, you can't just take business decisions on theories and gut feeling always. You need to, take data driven decisions, and Sid was unable to present data or analyze the data, to come to a conclusion as to what is really causing it. And this, I mean, if you look at the business, restaurant business, the main cost is kitchen supplies. And you can see even in the plan, it was 40%, and in actuals, it was, more than half the cost. He just had no handle or no idea what was happening. And, this was proving out to be challenging for him, and it was upsetting the investor. So this is where things stood at Q3. Okay, let's move on. Let's see then, what happened in Q4. Okay, now, eventually, after facing too much pressure, Sid eventually gave in to the investors' demand and agreed to move to a smaller place for the restaurant. Because if he wouldn't have taken that decision, and he also kind of saw that writing on the wall, if he wouldn't do that, he was going to very soon fall into a debt trap where, every time he will have to raise funds. So he had to, he understood the burning fire here, that, he had to kind of plug the leak of cash. So he had to get to a point where, the business would self-sustain. So he had no choice. He had to move to a smaller place of on a smaller premises for the restaurant. Okay, but on the positive side, obviously, so while he was struggling, in terms of the finance and numbers and financially, but he had built up a good reputation over 9 months, in the locality. Okay, so what he did was that, and this was a combination of factors. I mean, he was providing good service. The cooks were good. The food quality was very good. He had developed a goodwill in terms of what he did during the COVID wave. So there was lot of positive factors which were working in his favor. So he leveraged all of that, and that kind of helped him kind of increase his sales in Q4 as well. So let's see now, after that, what happened in Q4. Again, the format is the same, so I'm not spending time. The left side is Q4, and the right hand side is year-to-date Q4, or now, for example, the full year. So the original plan was for a year, and what we'll see here is how the year has shaped up at the end of Q4. So revenue was about 600,000. So it still kind of was off from the original plan or budget by about 30-odd%. Kitchen supplies. Now, apparently, it looks like, it's come in line with plan. But remember, the plan was to have a revenue of 875,000, against which kitchen supplies was to be at 330,000. Okay. The actuals was 600,000. The kitchen supplies in absolute terms was the same number. But if revenue was lower by 31%, ideally kitchen supplies should have been lower by 31%. So apparently it looks like, it's all fine. I mean, this was the plan and that's what he spent, but not really. This is a direct cost which has to be, kind of managed in terms of, if the revenue is higher, it's okay for such costs to go higher. And if the revenue is lower, then these costs better come in lower, else you will always have challenges managing your finances. So in that sense, this was not really a positive. Now that he had moved to a lower, to a smaller place, and had not, since he had moved to a smaller place, obviously now he didn't need the staff that was there in Q2, and that was already reduced in Q3. So those two expenses came in lower. So this was his reaction to, the changing circumstances or the real circumstances versus the plan. So there was a saving in terms of the rent and electricity costs, which were pertaining to the restaurant, which had now become a smaller place. Okay, and for this quarter at least, there was no external funding. So if you remember Q1, obviously, the investor had put in what was promised. Q2 and Q3, given the circumstances and given, how the business shaped up, there was a funding gap. So he had to arrange for external funding. But Q4, for the first time, doing whatever was done, so certain things positive, certain still, not going as per plan. Despite that, it was almost, it was still a little negative, but it was almost self-sustaining, and there was no external funding, which was taken for the first time in 4 quarters. So that's how things, kind of shaped up in terms of the numbers for Q4. Like I said, just, kind of looking at some qualitative aspects, the revenue progression was in the positive direction. So what I don't have here is how the revenue, a simple chart, showing the progression of revenue and P&L across, or rather revenue and cash flow across all the 4 quarters. But, the revenue was moving in a right direction. The daily revenue run rate was around 6,500-7,000, which was way off in some sense. And we've seen that, from the 10,000 target, but from starting at 3,000, going through a COVID wave, taking a dip and then recovering. So it was actually moving in the right direction. And as we spoke about it, there was no external funding and it was almost a break-even quarter, at least in terms of cash. But the kitchen supplies, again, continued to remain high. That was not fixed, and that still needed fixing even at the end of Q4. So that was something which was pending. So so what next for Sid? So we've looked at this story for 1 year, and so what next for our hero? So there was stability in cash flow and operations. So now obviously his focus would be to kind of while continuing with that stability, now explore more levels of growth from the current restaurant, as well as look at more branches for his restaurant, and with an understanding that the second round of external funding, or actually rather the third round, the second round from a plan point of view, this should actually be the third round of external funding, would be applied to the second round of external funding. What I meant here was second round of external funding was applied to fixing shortcomings in the business. Okay, the third round, it was agreed was going to be applied towards the next level of growth in the business. And obviously this the sore area that still needed to be fixed on the kitchen supply. So that's something that Sid still has to work on. It's despite being active to fix it. So that's still an area which needs to be worked on. What about for us? So this session, I spoke about this story, but obviously, the story may be interesting. I hope so, but we also have to, kind of look at that story more critically and look at, what were some of the mistakes that Sid did? What was it that we learned from those mistakes? And more importantly, kind of see and apply some of those learnings, as we start our entrepreneurial journey, or as we start looking at those in this who may perhaps in this session, or those who may look at it later on, who are already doing businesses, in terms of how you kind of learn from Sid and not repeat some of those mistakes in our business journey. So that's important for us. And here is where typically when you have these kind of sessions, I know this is an online session. Typically when you have these kind of sessions in a room is when, you kind of open up things for a more interactive, kind of discussion, which I don't know. I'm assuming, it's not going to be possible on an online session, but I'll just take a pause here before I get into the learnings. And, I'll just see, Saurabh, if you want to kind of chip in anything here before I, kind of move to the slides on learnings, Saurabh.
Yeah, absolutely. I'm beaming with 5 questions and I'll bring them up right away. First of all, very relevant case study, Irfan, very nicely put up in terms of the predicament which any person who's in his initial days of business has. You have this, you're passionate about, holding on to that restaurant that you built out, and, and there's somebody else telling you something else. You can't really live that. But just a few questions, just in order to, keep the flow on. You mentioned about, this was a seasoned investor and not like anyone else. So maybe you want to shed some light for the audience around, why have you made that reference, and, what is it that for us, as maybe first time people looking for funding, what should we be keeping in mind?
Sure.
Would you want to answer that right away, or?
Oh, okay. I was noting down the questions. I thought you'll just go ahead and.
So one by one. So maybe.
One by one. Okay. Yeah. Good. So yes, I mean, in this case, it was a seasoned investor who had responded. Now, why I brought this up is if you see in the journey, why I had highlighted this as a part of the case studies. If you see in the journey, the investor had picked up this pulse that, because of this COVID lockdowns, there is a shift. People's tastes have changed, and, there is a shift in the business, from dine-in to, takeaways and, home deliveries. And that was the reason why, he kind of picked it up early, and very early in the journey, he said, listen, let's move to a smaller place. Okay. And that's where, like you just rightly said, Saurabh, as an entrepreneur, Sid was not willing to let go. I mean, he was trying to build a restaurant with a different concept. So he was not willing to let go. There was an emotional attachment to what he was trying to do. And in that, kind of, thing, and which was validated, in the subsequent quarters, that it was, had he listened to the investor at that point in time, maybe his cash flows would have been better. And that's where, again, I wouldn't say that's right or wrong, but it's always important to listen to people with wisdom, people with, with more professional knowledge than you. Remember, I mean, Sid had all the right, energy. But he was a young guy. He was just out of college with 2 years experience, and he was an investor, perhaps, who was a seasoned professional investor. So, sometimes you got to listen to people, with contrarian views, and, kind of at least evaluate it more rationally, rather than, the emotional decision that Sid took, and saying that, while he said yes to the investor, in reality, that's what happened. He said yes to the investor. Okay, we'll do something. But he just, kind of delayed that decision by 1 quarter. By that time, he had no choice. And by that time, the cash continued to burn. So that's the reason why, I brought that up.
Yeah. And then you also brought out the fact around that revenues, didn't kind of make it the way it was planned. And at certain places, costs seemed equal to the plan, but that wasn't actually the plan. They had to be proportionally down. So, what is the point at which a particular cost, in your opinion, should we wait for how much time before a particular cost head, which is kind of losing its direction, it should trigger a response from us to address it? What, in your opinion, would be a deviation or a timeline, maybe a timeline around which we should start responding to something that's not falling in place?
Yeah. So it's a very good question, and it won't have a straight one sentence answer. And this was even one of the things that was there in the learnings, but I'll address it upfront.
Mm-hmm.
See, first is, it is very important for any businessman or any entrepreneur to know his costs.
Mm-hmm.
So, at times, and this is what happened actually in Sid's case also. And, I'm referring to that so that we learn from that.
Mm-hmm.
At times we start a business, okay, we don't put enough attention to capturing the relevant metrics for success, the data for the relevant metrics for success, and spending time in terms of capturing those data points and then analyzing those data points.
Mm-hmm.
Now, if you see, what was consistent across this struggle was that Sid was not able to analyze why the kitchen cost was coming high.
Mm-hmm.
Okay. And that was something that because he probably didn't put in the right data capturing mechanisms, the right MIS systems to give him that information.
Mm-hmm.
And that's something which, generally happens in a startup. Okay. But it is very important for an entrepreneur to, have the right balance in terms of, while there is obviously focus on, the business, the revenues, growing the business, and, kind of if it is something, a new concept, improving the concept.
Mm-hmm.
But it is very important to capture some of the relevant data. It's a journey, but you need to capture some basic data to be able to analyze actually what's happening. Okay, because if you don't, then you will lose your way. And, while you may think that the business is doing great, but there is some other part which is out of control, which is going to, kind of make you crash land, and you need to avoid that. So to be very honest, on the revenue side, it was doing fine. And, given the Q2 challenge of the COVID wave and, all of that. So, everybody, all of India lost 1 or 1.5 quarters. Okay. So he was on 7,000 run rate versus a target of 10,000. To be very honest, my personal opinion is he didn't do bad on revenue, but it was managing the other aspect of the business, which is the cost, which was actually the real problem here. And, again, talking about costs, it is very important to, for, entrepreneurs and businessmen to focus on, the gross profit. And I'll just take a couple of minutes here, Saurabh. What happens is that, when you have a P&L, okay, there is some cost which is needed to, kind of manufacture the product or to deliver the service that you are trying to deliver, which is your direct cost. Okay. And it is your revenue minus your direct cost, which gives you the gross profit. Then you have, all of your other costs, which is your general and administration, your sales and marketing. Now, it is very important that, your gross profits. So you may have, and more or less, although, it's not a rule, but more or less, gross direct costs would generally tend to be variable compared to your revenue. In this case, kitchen supplies was 100% variable. Not all direct cost is fully variable, but it is very important to even understand that what is variable and what is fixed and what is semi-variable. But again, not getting into those details, but it is very important to make sure that you always, kind of meet your goals on gross profit. It may at times be okay. Okay. Again, though, at times. So, I'm choosing my words very carefully. Let somebody not get any wrong ideas. It may at times be okay to temporarily miss your net profit or your cash flow targets, okay, on account of certain conscious decisions you've taken, okay, which, on your G&A or on your sales and marketing, because some of these costs may give, returns later on. So, as long as there is a strategy or there is a thought behind it, it may be okay to, kind of have higher costs there. But as long as you understand that those are out of your conscious decisions, okay, it is okay. but it is your gross profit, okay, which is very important. If you, for example, if you made a plan of 60% gross profit, and if you're consistently coming in at 40% gross profit, for example, okay, that's a red flag, because then inherently your business is not as profitable as you originally thought, and you will always have to find ways and means to fund that 20% deviation to plan. And you always get premium valuation. If when you talk of valuation of businesses, you always get premium valuation for businesses which deliver higher gross profits. So you may have a profitable business. So just as an example, you have two businesses. One is giving you 50% gross profit and 20% net profit, and there is another business, okay, of a similar industry, which is having 40% gross profit and is still giving 20% net profit. It's the business which has a higher gross profit which will have a premium valuation, though the profitability is the same. So that's why it is important for people to understand that it's important to understand costs. It's important to analyze those costs, and it is important to analyze the right metrics and measure those metrics to be able to evaluate performance while they do that in their journey as an entrepreneur.
On a very
very long answer to a question, but it was a very good question, and I had to say all this, and I hope I have been able to convey what I wanted to.
Yeah, on a tangential note, what Irfan just told me was something which actually took both of us back to a time which was very long back. We were running part of an organization with two P&Ls, one with a higher gross profit and one with a lower one. And I'm assuming it was a tangential reference to you did well, sir. So anyways, coming back to the point. So I'll just clarify for the sake of the audience here. When we talk about the P&L, just for simplicity's sake, anything that runs variable with the revenue, as in any consumables, everything that is kind of going ahead and contributing to every single unit sold, try and keep it in the direct costs. Semi-direct and disproportional things should be probably put in a set of variables below. So you will get a gross profit number, which will be a revenue minus the direct cost. And one of the things that we may want to think around as startup entrepreneurs is that talk to your industry colleagues who have been doing this work, because these ratios are largely etched in averages in stone. And you can get a very good reference by looking at some more established organizations and their P&Ls. And that will give you a point of reference. And yes, obviously, higher gross profits, better is the valuation that you can always expect. More on this maybe later. So I think, Irfan, let's continue with the flow that you had in your observations and proceed on.
Okay, so what I'll do, Saurabh, is, we touched upon a few things, but, for the sake of completion, okay, I'll, kind of now get to the learning slide and see, okay, what is it that we can, kind of learn from this case study. So first of all, Sid had prepared a plan, and even when he had prepared a plan, he had just one plan. So he had not factored in, okay, this was an ideal plan. And when you plan, you need to factor in, okay, what if something doesn't go right? Okay, so if you look at this particular story, there was one plan. Okay, he said, this is my plan, this is what I'm going to achieve, and he went ahead. But if he would have done some sensitivity analysis, okay, what if my revenue targets miss? What if my kitchen supplies cost come in higher? What if, okay, so if he would have done some of those sensitivity analysis, it would have given him an idea, okay, of what is it that he will have to arrange as a plan B to meet some of those contingencies. Now, what happened in this case was that, as he discovered that, things are not going as per plan, he had to raise funding on interest. And, when you raise funding on interest, okay, this was almost an emergency funding. The cost of this funding was very high. If he would have planned for, if he would have made a plan which would have factored in some of this sensitivity, maybe he would have been better prepared to raise those funds, maybe on interest, but it would have cost him lower because he would have been prepared. This was like, desperation. He had to pay his salary, he had to pay his rent. He didn't have funds. So he had to go and, kind of surrender in front of somebody who said, okay, I'll fund you. You have to pay me this much interest. So it's important to have these plan Bs and have some sensitivity analysis to every plan that you make to be able to know what happens if things don't work according to plan and for you to be prepared for it. So that's also one thing, that you need to keep in mind as you start new businesses. And I think I covered this point. It's important to tie up and plan well for investment and seed funds. Okay. This again, we spoke about this at length. Be on top of your gross profit. It might okay to miss revenue and profit targets for a quarter or for a couple of quarters, but you need healthy gross profits to bounce back. And this is actually something that still needs to be proven for Sid because his gross profits are coming in lower, and this is something that he still needs to prove. So this I think we've spoken in a lot of detail, so I won't spend more time on it. Okay, and again, I think Saurabh, your question was all comprehensive. I think we talked about this. Sid could not develop a decent MIS system, in which he could analyze all the reasons for why the kitchen costs were haywire. So that's one of the reasons actually. I mean, it was not that Sid didn't want to, kind of solve that problem, but he didn't know where to start. Okay, because he was not capturing that data. It emerged later on. It emerged, in Q3. By the time Q3 and the investors, kind of plunged more deeper into okay, what was happening, because Q2 he said we'll fix it. Q2 was difficult also because of COVID and all. Okay, so sometimes you yourself as entrepreneurs don't, we ourselves as entrepreneurs don't face the reality. Okay, we know, but we have other priorities, so we don't address that, and so he kind of swept it under the carpet in Q2. And then in Q3 again the problem was not solved, and by that time he didn't even know where to start. Okay, so the problem at the end of 4 quarters, although it was identified, remember, in Q1, maybe not as a serious problem, but in Q2 it was already a burning problem, and by Q4 the problem, it was not even addressed. It was not addressed, it was not looked at, because he didn't know where to start and how to fix it. So that's why, having some basic MIS systems which captures some of this is important to think about, because that will help you in your journey as entrepreneurs. This is not a distraction. It is an important aspect of, your operations, when you start an entrepreneurial journey. And like I said, you need not have the most sophisticated systems, as you begin, but you need to keep developing and evolving that, as you grow your business, because this is what will help you in decision making. And obviously this again we've touched upon. He was slow in agreeing to a change, despite the data showing that the business was not generating the expected revenues from dine-in aspect of the business. So that's. So these were 5 points. I don't know, Saurabh, if you've picked up anything that.
What I want to ask you is, because this is data and real data on a case study, I think will help. Irfan, if you could just go a slide or two behind, maybe sure. Where the MIS of Q3 or Q is there. You
want me to stay here Q4, or you want me to go back to Q3?
Q3 will be good to see.
Okay.
My reason to actually push us back to this number is because now this is like the 3rd quarter going on, and some points of decision making are typically here. Understanding that, you have a plan, you had a contingency in quarter 2. Quarter 3 is now a time where you can take some decisions. Assuming quarter 2 was still, it was a, an event of sorts. Here is a thing which, for people who are looking at funding and financing, he's gone ahead and picked up funds again. Okay. Wouldn't he be better off if he had just gone ahead and taken a slightly different credit line from his existing investor? Would that have come at interest rates lower? Is that an option?
So of course that would have been an option. In this case, of course, it was not relevant to the story, but the investor said that he's not going to put in more funds.
In a general context, say the investor put in an
I think the question, I'll rephrase the question more in terms of, in this case, he went ahead and raised investment, on interest. So could he have gone the equity route, not with investor X, maybe some other investor? Okay, now that could have been a possibility, but like I said, and that's the reason why I, kind of brought that point up, Saurabh, is he was reacting. See, here was a situation, he had not planned for this. And, he was not prepared that what happens if things don't go according to plan. Okay, so where will I get my additional funds from? Okay, so the investor X put in his commitment. What if certain things after that don't go according to plan? And that's where Sid was unprepared. Okay, now of course he had an option to go and look at equity. And if he would have been prepared, at the time of planning or even at the time of execution, picking up early indications, he could have done that. In this particular instance, because he was reacting, he had no choice but always go and surrender in front of another investor who was not interested in taking equity in the restaurant business. He said, okay, take this money, pay me so much interest. So it was because it was a reaction, it was not according to plan or, anticipating that, that there is more funding that is required. And that's where I left this story open-ended, because maybe, in some future session, maybe we'll look at the part 2 of this, where, after Q4, I said, there is still a journey that needs to kind of cover. So, if I get an opportunity, maybe, I'll, do a second round of the case study and present it in some future forum.
Right. A key learning which all of us can keep in mind when we are raising funds, why a plan B is necessary, is because many a times when you are trying to get to your first investor, they bring in a lot of rules which avoid you or prevent you from going after another round of investment early. They also have many rules which kind of make it a little difficult for you. They may have veto powers to go ahead and tell you that they can't raise funds from other sources. Now, this prevents the entrepreneur from growing the way or taking a direction that he or she would want to take. So when you are looking at raising investments, and if you have a plan B, as in you have thought about contingencies, you will always realize that investments may not come from the same source, or the same source might actually stop you from raising investments. That's why in seed, typically the numbers are below 26%, because once they get into 26% equity, they can start creating a lot of reasons why they can block you from going ahead and raising further funds. So this is one very big reason why you must have thought of contingencies and be very careful in what equities you are shelling out or what rights you are shelling out. Another piece which you can keep in mind by looking at this case over here is that, and then maybe this is something which Irfan, you may want to say, why is it that the organization is not evaluating an increase in unit price? If they had increased the price per unit, the revenue would have gone up for the same number of orders. Okay, and that could have therefore made the gross profit better. So anything on that, or what would be your take in this case?
So again, it's a very good question, and I'll answer that because I have insight into the case study. It didn't come out, in the story. Now, this was a newly, so this restaurant was set up in a new locality, a new upcoming locality of Pune. Now, they were, and again, go back and, just keep the timing in mind. This was sometime around January. By the time, all the havoc of the first wave and the first lockdown was already behind us. So he had, kind of set up the restaurant at that point in time. And that, at that point in time, first of all, since it was a new locality, there weren't very many competing businesses. And, a few competing restaurants which were there, they had shut down in the first wave. So now, he had come in, Sid had come in and set up this restaurant. But, he first is, at the very beginning, he couldn't start at a very high price because he wanted to, kind of first is capture, market share. So he had limited ability to do that. And by the time, things progressed, there were more restaurants which opened. So there was a competitive pressure. So the pricing power that he had was limited, because then he couldn't get to a situation where he would be selling his, in this case, his meals at a price which is higher than the competitive price. So that would have been ideal, for him to be able to, kind of increase his gross profit. But obviously, the market conditions were not such that he had complete power in being able to do that. He did that, to some extent in Q4. There was, and it's not coming out in this story, but there was some amount of increase which happened. And in fact, in Q3 also, it was very interesting. Actually, I'll share this with you. In Q3 also, what happened was that Sid, because he wanted to initially capture the market, he was giving deliveries at free of cost. So even if there was a 150 rupee order, okay, he was giving deliveries free of cost. He had a full-time dedicated person who would, kind of start his bike and go and deliver in the entire locality. The investor said, okay, let's raise our revenue. So why don't you start charging for deliveries which are less than 250 rupees? Okay, so charge some nominal amount, 20 rupees or whatever, for deliveries which are on orders which are less than 250 rupees. So Sid actually implemented that for a week. But because all his customers had become used to
for them charging again would be
free deliveries, the moment he implemented that, there was a huge pushback. Customers started calling him saying, "Arey, why you are charging 20 rupees extra? You were providing this." So he actually implemented that, but then had to pull it back because then there was huge pushback from the customers. So even that idea of slightly increasing the revenue on lower value deliveries, even that he couldn't implement. So there were market forces at play which kind of restricted his ability to go all out and have a monopolistic view on prices. Sorry.
Again, in the restaurant business, one of the things that many people have come up with this idea over the last 4 or 5 years when we've mentored teams on pricing. And the value proposition which comes to mind in most people's mind is that I want to be evenly priced or lesser priced. Or if you are very confident about the quality of what you're delivering, and it is home-based kitchens and not mass kitchens, look at the arena in which you are working. If the population is health sensitive, you can always have higher prices. So higher per unit prices is a necessary expectation which is set in the minds of most people who are in the SEC A. SEC B, C will think differently, but therefore don't try and underprice to get higher volume, because then changing the price and increasing it later becomes very complicated. So always better to have a mix of certain things which are higher priced and mix of certain utilities, also utilities which are there. For example, extra ketchups, extra things, and whatever you're giving, at least for restaurant business, try and see if there's some way you can package it in the pricing of the main thing itself, rather than show it as a separate one. Anyways, this is more like a deviation. One more question here around: how would you recommend, maybe beyond this case study, that the legal and finance aspects are managed when a startup is running in its initial days? Because it brings in a lot of effort that entrepreneur has to get ready for, which he or she may not be aware of. What would you recommend for startups as the way to go about it?
See, for startups, I would recommend that, for these aspects, go out and seek professional help. Don't try and solve these problems on your own. I mean, your expertise would lie in running the business, in knowing the business and in running the business. So focus on that. For legal contracts, for financial and statutory compliances, go and hire the right people. Factor those costs in your plan. So when you make a plan, factor that in. Now, once there is enough. See, there is always there are two models here. You either go and hire them as employees, or you go and hire them as consultants, or on a need to know basis. So at some point in time, I don't have a ready formula for it, but that's for the entrepreneur to decide when he needs somebody in house. But if you're starting, don't try and kind of solve those problems, because entrepreneurs, especially young entrepreneurs, which we have nowadays, they don't pay attention on these aspects, and some of these problems blow out later. So it's important that these aspects you pay attention to, factor that in your pricing, or factor that in your costs and plan, and kind of manage it well. Everybody kind of goes through a learning curve. I'm sure entrepreneurs who are not very conversant with these aspects will learn through it, and will get better. But yeah, I mean, if you know that you're not good at a certain aspect and that's not your core strength, go and don't hesitate in hiring the right people to complement you there.
Okay. One question which is coming in here is around why should higher gross profits earn better valuation? Can you just shed more light on this?
Yeah. So see, again, the higher gross profit tend to tell you 2-3 things. One is if a business is earning 60-70% gross profit, it tells you that you have something there, either in terms of the product or service, okay, or in terms of the uniqueness of your product or service offering, which enables you to charge a certain premium. If you look at, for example, most of the businesses which have been commoditized, you don't get that high gross profits. You have to live with 30-40% business, and it's a volume game. But it is for specialized, kind of innovative businesses, new age businesses. That's where you kind of charge these premiums, okay? Because then, it tells the investor that, okay, you've got something here where you're charging a premium for. And it gives you the ability to, kind of, and if your gross profit is high, that tells you about the good quality of, whatever business you are running. And it gives you the ability to make decisions on your, temporary decisions on your sales and marketing, on your G&A costs, okay, which kind of you can deploy for future growth. So higher gross profit also gives you more ability to generate that much cash and be able to kind of deploy that for future growth, whether in the same line of business, or you want to diversify into some allied line, or you want to add up more complementary services or products. So that is an indicator. And which is why I made that distinction that having the same net profit, two businesses are having the same net profit. It is the higher gross profit business which gets the premium valuation, because that talks about something which is better inherent in that business, okay, which is giving it a higher gross profit. Okay, there are businesses, and again, pre-IPO and all things where people kind of tend to manage numbers. It's not something that I kind of advocate or subscribe, but it's a reality where people, and if you really analyze some of, not everybody does it, but if you sometimes analyze, they manage numbers. How do they manage numbers? I mean, gross profit is what it is. It's not going to change over quarters, unless you are making some real good decisions in terms of improving it. But people avoid or delay costs on sales and marketing and G&A to get to higher net profit and get to higher net profit numbers, so that their valuation is better. So those who are involved in stock markets and all, they always kind of look at, okay, peel the layer and look at, okay, not the net profit, but what is actually the gross profit, and how things have evolved over the last few quarters to analyze these reports. So that's the reason why gross profit is very important in any business. There's no one number. Certain businesses are very good at even 30, 35, 40% gross margins because they have lower SG&A. Certain business need higher gross profit to sustain, because they would have a higher SG&A cost. So each business line is unique in that sense. There's no right answer, but compared to the industry, if you're on the higher end of the gross margin, you'll always get a premium.
Okay, I think that kind of sums up most of the questions here. Purti and Digvijay, is there anything coming in your side? Have you received a message or two that you want to add on here?
Yeah, sir, just checking the chats and mails that are it. You have mostly covered almost everything. Just let us check.
One subtle aspect on the same sheet, Irfan, when there was a reduction in staff that was done in this case study, we typically tend to adjust costs or reduce costs by reduction in staff. It does have an impact on the net deliverable quality. So how do you, what should be trigger one? Should it be to first reduce the staff, or should it be to actually reduce some other types of costs? And How do you plan for it?
So again, there's no right or wrong answer here. I mean, it's for the entrepreneur to decide. Okay, what exactly is going to kind of be there. Here, if you see, Sid had a choice. The investor told him, go reduce your rent cost and infrastructure cost by moving to a smaller place. And he remained in a larger place. See, the larger the place, the more staff you need. So he remained in a larger place, but reduced the staff, which seems to suggest that, he already had some buffer there, which is why this was an easy decision for him to make. He wanted that emotional connect with that place. So, it was an easy decision for him to make. So, entrepreneurs generally know where they have their buffers and, when things go wrong, which buffers they will use to kind of manage temporarily or in the short term. Good entrepreneurs will always have some buffers which they will release at the right point in time, which is what happened in this case.
I think summarizing, folks, I think what we all need to keep in mind is that these kind of case studies are, very good ways of being able to, relate to the journeys that you have got. Most of the entrepreneurs who would go through this will relate immediately to all the 3-4 factors which Irfan has covered so well today, and helped us understand, what are the levers that you have got, when is it that you need to react, what can be business situations, the unpredictability of the same, and how you probably can react to go ahead and, get yourself back in order. I think we've covered today things around cost of funds. We've covered today things around raising loans versus investments. We've talked about gross profit. We've talked about legal issues, talked about increasing in price. We also looked at, when is it that you need to react to certain variances happening in your plan? Talked about plan B. Quite a comprehensive set of things that a typical business would face. And I think we can probably, all that I can conclude on is like, I think we probably need more. So Irfan, I think some more case studies in future, and I think that should just help. Great. Okay, there's a question here. What should I look for while looking for an investor? Okay. Okay, I'll kind of just take the shot on this one. Look for somebody who has done business or has invested in a similar type of business, because that means they will know the arena a little better, and they will be able to give you some better relevant advice when required. They will also have a pulse on the dynamics of that market, because they have invested in other ventures, so they will see similar terms. In my journey, I can explain one case. We were raising almost about $1.5 million from an HNI investor, and they had a very one of the A-grade investors in their organization before they invested, and that A-grade investor had actually invested in a very similar venture. And in the very first board meeting, the investor raised a very relevant point, which actually became the bane of our business about 9 months later. His point was that, in your business, you will find it difficult to go ahead and find customers. Customers won't walk up to you. They will not respond to you when you walk up to them. So what is the strategy you have to counter that? And he was saying it out of experience. My point being, when you're looking for an investor, look for somebody who has already invested in that type of business and has a track record for the same. Any other points, Irfan, you might want to add? How do you?
I think you've covered it well, Saurabh, and I, if just so that people can relate to it better. I'm assuming most people here would have seen Shark Tank, if not the foreign show, the Indian one. And you see, many times, the sharks who were sitting, they would themselves decline, or the people who had come in to pitch for business, even if they had multiple offers, they would not necessarily go with the best financial offer, but with the shark who would add more value to them or be able to solve their problem. Right. So if you have choices, yes, I mean, what Saurabh said is an ideal situation. Sometimes you have choices, so look for that value add. Sometimes you don't have choice. Okay, in that situation, obviously you go with what you have. But where you have choices, you certainly look for an investor who can add value to what you are doing.
Yeah, my strategy to all the newbies who are around, and I've been telling this multiple times in sessions, don't go to the investor. Okay, go to the bank first, prove it to the investor that I can raise a loan and I can pay it back, and then you will go to the investor when the investor needs to come to you rather than you having to rush. And one of the things you must keep in mind around the case study today, it is a real case study. the numbers are infinitesimally small. Okay, and this is something which we must all pay attention to. When you are newbie in startups, it's not about millions and billions and those large numbers that we need to be talking about. Even when I saw the numbers for the first time, I was saying, wow, this is operating in lakhs, and which is great, because this is the level at which your ability to create credibility will increase. If you've dealt with numbers at this range, that means you'll be able to do much larger rounds later. Okay, Dharmesh has been on since last week, it seems. So he has a question here for us. How to factor in the passion and gut feel of the entrepreneur. Here, Sid may not have been emotionally attached to the larger place, but in the restaurant business, location is everything, and changing location can impact business adversely. So his question is around change of location, because it could impact, and how to factor in passion and gut feel of the entrepreneur. What should the investor be thinking at this time? Maybe that's what Dharmesh wants to ask.
Correct. So coming, I'll answer the easier question first on the location. If you see the investor advice or the investor recommendation, at the end of Q2 was to find a smaller place in the same location. So even the there was a goodwill which was there. There was a customer base which was created. So it was never about kind of changing the location, but just trying to find a smaller place in the same location and trying to build on what was already kind of there. So that was the investor recommendation. Coming back to the passion and gut feeling, yes, see, these are areas where again, in this case, the investor had picked up the pulse and said, move, because your business is now being more takeaway. Okay. It could, in any other story, maybe there would have been a different strategy and it would have bounced back by not listening to the investor. Okay. Then the story would have been different. Okay. Here, our conclusion is different because it was the investor's call, which seemed to be more appropriate. And that's where, I personally don't criticize Sid. Why? Okay, because he went with a gut feeling. It didn't work out. It could have worked out. But the point to make is that, this is something which only Sid will know. I, as an external person, will never know. Was that an emotional decision? It appeared to me it was. That is why I used that phrase. But it is only Sid who will know whether it was an emotional decision or whether it was, little more belief saying that, no, I'll turn it around. And that's something that, is only the investor, the entrepreneur's decision. You got to respect that after a certain point in time. But it is more important for the entrepreneur to be able to, kind of be true to himself rather than an investor. Am I making an emotional decision, or I have a game plan to turn this around? It may appear to be an emotional decision to a third party, but do I really have a game plan to turn this around? Do I have the confidence to turn this around? Is it hope, or is it backed by a game plan and strategy? That only an entrepreneur will know, and he has to be true to himself and not get emotional about what he's trying to build there. It's not easy. It's definitely not easy, but that's where people generally make a mistake, where they are unable to kind of dissect the problem, whether this is emotional or this is belief and a game plan. These are gray areas. Okay, it's more inside the human heart and the human mind. So it's only the individual will know.
I think one piece we can all keep in mind is you will be able to assess your own nature. Are you somebody who reacts to, or who is passionate about something and takes it forward? It's an essential trait in a entrepreneur. And do you get in the sway, or are you somebody who can pull back at times? Based on the same, have an advisory board. Okay, and an advisory board who can go ahead and give a radar to your journey. Obviously, you have to decide whether you want to listen to your advisory board or no. But the advisory board who comes from the same domain, like in this case, he's a civil engineer. I think Irfan got back at me for being an engineer. But in a restaurant business, can you imagine? So now having an advisory board would probably just help in making sure that you get some radar to your numbers, and a good comparison is there.
Yeah, and if I may add, and this may be music to Dharmesh's ear if he's still there. It is important for entrepreneurs. Yes, you said as an advisory board, If not an advisory board, at least have some mentor, okay, whom you can, at times go and bounce your dilemmas, your problems, what you are thinking. Okay, at least have a mentor who, who's seen the world, who knows the space, or who may not even know the exact business, but somebody who's seen entrepreneurship and has guided others. So have those kind of people in your life, with whom you can bounce back and use as bouncing boards to at times validate your thinking. And this is what I said, maybe music to Dharmesh's ears if he's listening.
Right, there he reacts. Okay, Dharmesh, hard to keep you on mute, but let's do this for the sake of the session today. And given that we are on this time, we'll kind of drop off here and maybe just connect after this. And anybody who has questions around the same, you can still mail in and you can send messages. We can have Irfan respond to you. All of the people and panelists who are part of Seed are available to everyone to be able to help them in their personal pursuits. We are now starting to conduct sessions offline as well. So besides this online set of sessions, we've started working with incubators and colleges in having sessions around a range of subjects which are around IIC. As also there are subjects around one-to-one mentoring. There are also certain programs around ideathons, business model canvas. So it's a range of things. Check out our website and you'll get to know more details. Thank you for joining in today and contributing with your questions. I hope these recordings and these sessions will be helpful to all of you in your journey. We'll sign off from here, Purti, unless you have something else.
No, sir. Everything is covered. Thank you, Irfan, sir. It was a pleasure learning from you.
Thank you for having me.
Yeah.
Thank you.